Good morning, everybody, and welcome to the 2013 webcast and interviews of the very first Behavioural Finance Forum. We've got a very interesting selection of panels today, and we're talking about what can behavioural finance teach us about financial crashes. We're looking at emotions and trading. We're going to be looking at corporate finance and the impact that emotions have on deals, and also fund management performance. But before we go into those panels, we're going to get my colleague Heather Fairfield, who's going to talk to Greg Davies, who is head of the behavioural finance team at Barclays, to talk about his book.
Greg, thank you so much for coming today. And I did want you really just to set the tone and the stage for this debate, because you've written this amazing book called Behavioural Investment Management, people can see. And it really talks about ways that we can evolve in financial matters so that we avoid all the ups and downs and the crashes. Do you provide watertight solutions?
There are no watertight solutions, and behavioural finance is never going to fundamentally resolve certain issues of human nature. We're always going to be prone to booms and busts. We're always going to be prone to short-term thinking. What the book tries to provide, and indeed most of our work at Barclays tries to provide, is a menu of options that help people to deal with the present in the pursuit of long-term financial goals.
And I was very intrigued that halfway through the book you start talking about Ulysses and sirens. Why do you do that?
Well, the biggest problem for most people with investing is not knowing what the right answer is. We've been told by financial academics what the right answer is for decades, centuries even. I mean, Shakespeare mentioned diversification in The Merchant of Venice. The real problem is that we as humans have emotional responses to the investment journey, like Ulysses did when he was going past the island of the Sirens. And if we're to get good results, knowing the right answer is only a small part of it. What we need to do is to develop a set of techniques or interventions that can help us to control our own behavior in those times of turmoil.
So that's dealing with anxiety, which is a natural human emotion. What sort of tips have you got?
Well, the thing about anxiety is that financial professionals or financial professors will tell you that what you need to do from your investments is you need to pursue maximum risk-adjusted returns. And then we enter into all sorts of discussions about what we mean by risk, and it gets very technical and very abstract, and it's largely nonsense. What people mostly need is the best anxiety-adjusted returns. What people really want is the best returns they can possibly get relative to the stress, discomfort, and anxiety they're going to have to endure over the investment journey. There's a range of ways of doing this. Some involve actually changing the portfolio itself. Some are much more about communication. A lot of anxiety arrives not through the actual risk you take, but through your perceptions of that risk. And some are sets of rules that investors can impose on themselves, self-imposed Ulysses strategies, if you like, to help them control their own behavior.
And how do you educate people to invest for the long term? Because you were saying to me earlier, a lot of pensions, just private pensions, have a 4-year horizon.
Yes,
Terrible.
I mean, the FSA research shows that people who open a personal pension stop paying into it within 4 years. Now, that's not long-term investment. The best pensions are the ones where you don't really know you're in them because it's taken out of your pay each month, where somebody else, i.e. your employer, puts in 3 or 4 times as much, and where every other taxpayer puts a subsidy in as well, so you've got a much bigger fund than you're ever paying for, and then you forget about it for 30 years. That's the kind of pension that works, and that's what the government's trying to do with auto-enrolment.
That's what they have in Australia. And it's actually better for your companies as well, because it means there's a large pot of money there to invest, which then helps to finance your industry.
Yes.
So Nicola, do you think that the change to defined contributions plans has made things more difficult?
Yes, obviously it's made it more difficult for the recipients, because in the past, if you'd had a slow, long decline in markets like we've had, especially in real terms, if you look at the returns over 14 years in real terms, it's diabolical.
Brian, I'd like to talk a little bit more about the big financial crashes that we've been through over the decades, because I think people are really fascinated by them. And there are all sorts of theories out there, aren't there, about why they happen, and people can't necessarily agree. But I was going to ask you, the 2007 crash, what's your view on that?
Well, I think there's 2 quite different ways in which people look at these crises and crashes. One is the technical view, which says certain technical aspects were wrong. And if we fix them, then we won't have crashes in the future. And I think some regulators, I hope not in this country, actually believe that what we need is technical fixes. And the problems which they see as being the ones that need to be resolved are that products are over complex, which they were. There was fraud in the mortgage market, there's moral hazard, there's adverse selection, there's principal agent problems, there's erroneous models. All these things are technical and they can be fixed, and they should be fixed. But the fact that there are all these technical problems does allow the people, particularly those in Chicago, who still believe in the rationality of man and mankind collectively as well, to believe that if we fix these, we solve the problem. Because I hope they by now believe bubbles do exist. But until recently, economists would actually say there is no such thing as a bubble. It's like in economics, we say there's no such thing as a queue. There's only mispricing.
Francis Hudson from Standard Life Investments. Can I ask you, how much does emotions play a part in your area?
It plays quite an important part. Knowing how investors are positioned is quite important. So you can either take a Minsky taxonomy of bubbles, and every time somebody says paradigm shift, it should raise a warning flag. And then you start looking at the behaviours around it. We look at things like fund flows, and if the whole world is piling into Apple, then the most likely thing is that Apple's going to fall. It doesn't take that much intelligence to be able to read what's happening in the markets and to act against the aggregate.
But I was going to bring Greg back in here, and it seems to be that we never learn from history, Greg. Why not?
It's human nature. I mean, Daniel Kahneman, in his book that he wrote last year, Thinking Fast and Slow, draws the analogy of us having two systems of reasoning. There's our emotional intuitive brain that is always in the present. It's always switched on. It's always feeding us with information about our environment. And then there's our deliberative brain that allows us to sensibly think about long-term planning, etc. Unfortunately, most of the time, particularly in times of crisis and turmoil, it's our emotional short-term brain that dominates. And so in order to learn from history, you need to be perennially dispassionate and perennially long-term, and humans just aren't.
I'm now going to turn to a panel on my right, and I'm going to be asking questions about emotional trading and what happens to traders' brains when they get involved in making large amounts of money. And I've got Professor Fenton O'Creevy here, who I've interviewed before on the subject. It's really fascinating research you've been carrying out. Do you want to tell us a little bit about it?
The first thing I want to say, as we talk about emotions, is emotions sometimes get a bit of a bad press. It's really important to understand that actually emotions are a necessary part of our decision making. We can't function without them. So we shouldn't fall into the trap of thinking emotions are bad, somehow we've got to eliminate them, and then people will make good, rational decisions. I'm just thinking, for example, of the example of driving to work and a child runs out in front of the car. It's that sudden surge of fear that enables you to spot immediately that there's something going wrong. You've got to take action immediately. It's really, really important you react quickly. All of your cognitive resources get focused down on that one task. Similarly, we know that when people are in receipt of large amounts of data, that often it's their emotions that spot the pattern before their more rational thinking does. And that your emotions give you quite important cues. And we're talking to lots of very high-performing traders. One of the things that they talked about is about the way in which they use their emotions. The interesting thing was that actually the traders who were the top-performing traders versus the more modestly performing traders, there are no poorly performing traders who've been there a long time, they tend to get weeded out. But the big difference between them was not whether they talked about having intuitions, but how they talked about them. And the ones who talk, the really top traders tended to talk about the ways in which they brought their intuitions into their critical awareness and brought them alongside other kinds of data.
I'm just going to move to Joe Rundle here, because you're very much involved in trading for your company. And do you have any foolproof tips and advice to traders from your experience of how they can manage their emotions?
Well, unfortunately, there aren't any foolproof methods, but I do agree with Mark. Emotions are very important. What I find is that you need to have discipline around those emotions. I find it very useful to always evaluate why you've done a trade after you've made that quick decision which is based on emotion, and write it down, and therefore when you then get caught up about the trade going offside or against you, or when it's going in the money, you can then refer back to that and you can have the rational decision to then look back at and see whether the emotions of the current moment are correct. So I think they're hugely important to have discipline, but wrapped around a set of emotions to help you make that quick-paced decision.
Do you think that, this is a bit of a cheeky question, do you think journalists have always got it right when they've been reporting on these financial crashes? Have they focused on the right things, on leadership and banking, that sort of thing?
But then, isn't the great thing of the past 5 years, the lesson we've learnt is that we're all idiots? You know, I mean, I've sat here and think to myself, you know, we can all agree in this room, everybody, you know, whether you're serving the water or, you know, anyway, we all agree we're irrational. What I was intrigued about when I read the professor's research yesterday was how we learn from the lessons, because I assume that's why we're all here. And the professor, you say in your research that a third of feedback actually makes things worse. It actually, performance falls. And if that's the case, then how can you possibly use that feedback in any sensible way?
Can you tell us how company chief executives and chief financial officers develop a fantasy approach to M&A projects when they're looking to do the big deal?
Okay, it's interesting you talk about this fantasy approach because, you know, the standard research in finance would say that managers are making very good decisions, you know, maximising shareholder value in their M&A deals. Then we had the behavioural corporate finance development, which was talking about managerial overconfidence, hubris. You know, these are all the reasons why, you know, deals are quite often value destroying. Okay, the evidence, deals are value destroying. Now, when you talk about fantasy, okay, so the latest sort of cutting edge research is the emotional finance side of things. And what the emotional finance is doing, built on works by Professor Taffler and Tuckett.
It was Richard Taffler of Warwick and
David Tuckett.
David Tuckett of London.
Yeah, originally from the US. So together with them, what we're finding is that people become very emotional in a Freudian framework. Okay, so it's this idea that people have these unconscious emotions, all of us.
You see a lot of deals where emotion comes in and takes over. You know, you mentioned RBS taking over ABN AMRO. I think, you know, that was a deal where they came from a background where they'd acquired NatWest, they'd done that very successfully, they knew how to...
Domestic deal.
They thought they knew how to acquire a bank, they thought they knew how to take on something much bigger and do it. And of course, they got themselves into a situation where it was completely different and not what they'd done before at all. And I think we do see that. We see people go into deals with, you know, views on what they can do. Previously I was at the Pru. The Pru famously lost a ton of money buying estate agents because it thought it could magically cross-sell insurance products to estate agents, and nobody really tested that.
Do you think investors can smell hubris in a deal?
You know, if you look at AOL Time Warner, that was a hubris deal. I mean, I think the way to look at it is that chief executives, we pay them very high salaries on the supposition that they're brilliant. They're not usually. It's the rest of the business that keeps them going. So when they come in, they have to do something, like a football manager has to buy Ronaldo or Messi. So they do a deal. And it almost doesn't matter what deal they do, because if they don't do a deal, then the stockbrokers, analysts, and investment bankers are saying, if you don't do a deal, then somebody will make a bid for you. So then when they do a deal, they're subject to the winner's curse, which is a well-established problem in auctions, that the person who gets the prize is the one who's overpaid for it. And then subsequently, and the life expectancy of a chief executive is something like a football manager, then they don't unwind the deal, but the sunk cost problem, as the other gentleman has mentioned, and so it's the next person who unwinds the deal and then gets praised by the market for restructuring the business, writes off, can start with share options priced at a lower level and get rich all over again.
Professor Rao, can you say anything about different cultural approaches to investing? I mean, you were based in San Francisco at one time, you're based in the UK.
I don't think human beings are actually very different anywhere across the world. I mean, we all have day jobs. We all have, except for people in the finance industry, this is our day job. But for most of us with a regular job, we have limited attention, and that stays constant regardless of your culture. So whether you're Japanese or whether you're American, there's only so much time you can spend to your portfolio. So you can take part of your portfolio, have fun with it, but you might likely to lose most of it.
Can I bring Edward Haddis from Reuters? Can I ask you the question whether fund groups are cynical exploiters?
I remember sitting around with a marketing guy from our fund group who said, our slogan is something about how what you see on the label is what you get, that we're very accurate. And there were a bunch of us, analysts and portfolio managers, who said, but that's not true. We change our portfolio construction all the time in order to match whatever is hot in the market. And the label is very inaccurate. And the guy said, yeah, but people want to be told that what you see is what you get. So we will tell them that. And I felt that was a level of cynicism that was a bit much, even by the standards of the industry, of cynicism. I'm happy to say that group has lost most of its assets, so there is some justice in the world.
That point about 24-hour knowledge, and there's a huge amount of information that's available to DIY investors, DIY portfolio managers. Does that make life more difficult in the advice market, or for people like Barclays to talk to people about investing?
Yeah, I think that's an excellent point, that the 24-hour news cycle makes certain events more salient or more available to people, and it gives investors more information that they may want to act upon, that they may want to react to. It elevates emotional reactions to current events, and just makes it increasingly difficult to take that long-term, disciplined, diversified view that we would like to encourage with investors. So I think it does, in a number of ways, turn people's eye away from the horizon.
But the answer is yes. I think investment managers are pretty
Nicola,
cynical.
to ask you, do you think that success in raising money, fundraising, to get people to invest in funds, does it really mean that you've got to fit the current zeitgeist, you've got to go with a certain herd flow, or is that just rubbish?
Well, a lot of people are actually advised by independent financial advisors in the UK, and they do tend to follow performance trends. So you do find that the fund that did best over the last 2 years is the fund that's getting all the money at that particular moment in time. So there is definitely a herd instinct. And generally speaking, as we all know, that's normally the moment you should be selling a fund, not buying it. There are some people who perform every year, but they're few and far between. Even the very best fund managers have periods of outperformance, then periods of underperformance.
Right.
So you should really be buying the ones where you believe the fund manager is still a good fund manager, but has just been through a period of underperformance, rather than rushing into the one that's just done really well.
So it's timing is very important.
Timing is important.
Brings us on to Lloyd Rayner from Russell, and you had some interesting thoughts on trying to advise clients to buy funds, and the timing, it can be difficult.
Sure, I mean, the issue is Russell put together manager of manager portfolios, partly to effectively ensure that individual investors don't have to have the burden of picking managers themselves, because the issue is often you need to have the expertise in place to look under the bonnet, so to speak, to understand the stocks that are actually in funds in the first place. As well as that, it's important to have the right index against which those managers are being measured. So, for example, if you are investing in a value fund, for example, you should have that fund potentially evaluated against a value index, because that allows you to check whether the fund is actually remaining true to its stated investment style.
Thank you so much. And please watch out for the edited highlights that we're going to put up of the chat. And thank you to the audience as well.
And people will be able to view the webcast again.
Yes.
And the highlights, of course. So thank you very much. Thank you very much for coming.